Here's why I think real estate will be the #1 performing asset class over stocks, bonds, cash, and Bitcoin. I'm Jonathan Castlein from Liberty Title here in Port St. Lucie, Florida. And let's change gears here a little bit and talk about macro. Macro is always a very tough algorithm to understand and define, but let's just do some basic things. Firstly, the #1 thing to understand about macro asset class, asset allocation, is that all these assets compete for capital. The capital for equities compete with the investment opportunity for stocks, the investment opportunity for bonds, the outlook for cash, and now the emerging asset class of Bitcoin. So what's going on here in the US economy as we exit 2025 and enter 2026? I think there is a substantial analog between the period we're entering into 2026 and 1998. We're seeing a massive overinvestment in US technology, and hence US technology stocks are massively overvalued with extremely high multiples. Look at the situation we have currently. NVIDIA has a $5 trillion market cap. Microsoft has a $4 trillion market cap. Apple also a $4 trillion market cap. These multiples have never been so high ever in the history of the US stock market. Conversely, in 1998, multiples were again very, very high. But conversely, Cisco Systems, for example, had a market cap of $100 billion, a small fraction of where these tech stocks are trading now. Now, the environment in 1998 was very similar to where we are now. There was a huge pull forward of investment spend to prepare for Y2K. Y2K was a situation where the US economy and the US technology sector was preparing for a big event into the year 2000. That event never happened, the investment was overspent, and tech stocks crashed several years later. While I don't see an impending crash, I do see a macro environment which is very similar. Currently, all these big technology companies are spending billions and billions of dollars on the latest AI functionality. Actually, the total currently is $1 trillion being spent on the infrastructure for artificial intelligence. Now, what's interesting is the revenue opportunity for this $1 trillion investment is only $50 billion, or a 5% return on investment. There is no way anyone should ever make an investment based on just 5% return. So what I think is technology stocks are entering a very late stage cycle. I think we'll see all these mega cap, these trillion-dollar companies potentially have a good start to 2026, but then we'll start to roll over significantly into the end of next year. So what do? We know equities and stocks are overvalued. In this environment, bonds are actually a fairly decent investment. Interest rates on the margin are coming down a little bit. You're going to start collecting and clipping coupons between 5 and 6% in the corporate bond sector. That's a decent rate of return. Cash, not very interesting, never has been. And again, as interest rates come down, people should be deploying cash in the best sector. Why I think real estate will be the best sector is because the fundamentals are much more favorable. Inventory in the US real estate market is at 15-year highs. So as a potential new buyer, you're getting a look at a great number of new supply, whether it be existing home sales or new inventory from home builders. So you don't have to make a very quick flash decision on the property you want to buy. You're going to be able to see a lot of properties. Second point is, again, interest rates on the margin are going to come down, so affordability is going to improve. That's been really the first situation this cycle since COVID in 2021 that interest rates are actually starting to come down. Thirdly, inflation is likely to remain stubbornly high, and there's no better inflation hedge than the real asset of real property. Finally, there's Bitcoin, which I think is entering a fairly precarious, dangerous setup for this new emerging alternative asset class. The industrial logic of Bitcoin is quite difficult to understand. I know what Apple does, making handsets, chips, memory devices. I know what Google does, which is create technology advertising and search revenue streams. I know what NVIDIA does, creating chips. Bitcoin, by definition, the industrial logic is quite murky. What exactly does the technology do? I know there's a limited supply of it, 82 million units, and therefore there's some scarcity value to Bitcoin. It's argued that it's the new digital gold. That's neither here nor there. But because the industrial logic and the functionality and the use of Bitcoin is still pretty much up in the air. It's really a price stream. Now, price streams by definition have pretty specific growth and decay formulas. An Italian mathematician called Fibonacci basically explained the multiple with how things grow, and then conversely, the multiple in which they decay. Because I believe the price stream of Bitcoin now has started to inflect lower, you should look at Fibonacci retracement levels as to where Bitcoin will settle out in 2026. I see a Bitcoin price some 40% lower into next year, or Bitcoin approaching $60,000. So let's review. 1, US stocks are in a late stage cycle. Technology overspending is massive. The environment, again, is very much like 1998. There's substantial overinvestment in technology spending, which is pulling forward all these CapEx dollars, which will eventually peter out in the middle of next year. Also, in 1998, the Fed was forced to cut rates. It really didn't want to, but a currency hedge fund called Long-Term Capital Management went bankrupt and was insolvent. So there was a $13 billion bailout of that entity, which forced rates lower in 1998. You have the similar setup now. The Fed is starting to lower rates, really doesn't want to, which again will be good for performance into the beginning of 2026, but then again will roll over for equities anyway by the end of next year. Bonds in a pretty decent spot. I like clipping coupons there. Corporate grade investment bonds, pretty interesting here, especially with rates on the margin coming down. Cash, never that interesting. Bitcoin, again, I see substantial downside into next year, which again outlines our conclusion. The US real estate sector is the best asset class to be in as we look forward into next year. Rates on the margin coming down, increasing affordability, inventory at 15-year highs. That means there's more to look at. That means there's more incentive from the builders. With inflation likely to remain stubbornly high, that's the last benefit to US real estate, making it the best performing asset class into next year and beyond. I'm Jonathan Castling here at Liberty Title in Port St. Lucie, Florida. Again, you can send us contracts below to our address. We'd love to assist you in all your real estate needs.